Good afternoon, namaste. I hope you all have had, some tea, coffee, and are energized to watch this presentation. Um, so I work with the World Gold Council, and the World Gold Council is an organization founded by some of the world's largest gold mining companies. We produce a lot of data and research on gold, and the amount of data we have, probably nobody in the world actually has. So we are a repository for all things related to gold, and our role is to champion gold as an asset class, as a strategic asset class. And my presentation today will tell you why gold should be a strategic asset. So, we estimate that today in the world, in terms of the above ground stocks, there's about 212,000 tons of gold. And most of this is in the form of jewelry. If you look at this slide here, about 45% of gold lies in the form of jewelry. ETFs, bars, coins account for about 22% of gold. Central banks, including Reserve Bank of India, hold about 17% of gold, and others, which is about 15%, includes all our mobile phones, laptops, chips, all the servers that the artificial intelligence companies use. Everything has some gold. So gold is actually a financial asset, but it's not a largely available asset. It's quite scarce. And we've done some analysis on what drives gold demand. Why do people buy jewelry? Why do people buy bars, coins, or ETFs? And if you look at, the next slide, we've actually categorized, the demand into two categories. One is strategic, and the other is tactical. What do I mean by strategic? So if you look at periods of economic expansion, when a country does well, the economy is doing well, everything is growing, manufacturing is growing, these periods we've seen are actually quite positive for gold. What do I mean by that? When there is periods of economic expansion, gold actually goes up in demand. Similarly, risk and uncertainty also stimulates demand for gold. So we've seen 2 years ago, when the Israel-Hamas war or the Russia-Ukraine war started, gold actually went up. So risk and uncertainty also stimulates the demand for gold. The tactical drivers for gold include opportunity cost. So whether it's through currencies, interest rates, the opportunity cost of having gold versus other asset classes drives the demand for gold. And last but not the least is momentum, whether it's just taking advantage of prices that gold has to offer at any given point in time, that also drives demand for gold. Now, gold is a global market. Wherever you go in the world, you will get gold. You will have gold in the form of jewelry, bars, coins, ETFs. So in terms of the demand, 71% of the demand comes from the emerging markets such as India, South Asia, Southeast Asia. 29% of the demand comes from developed economies such as US, Europe, and so on. However, if you look at gold and its annual demand, gold actually has a dual nature. One is that of a consumption asset, which is through jewelry, and the other is through investments. So our estimates suggest that the annual demand for gold is about 3,100 tons, and of which 35% of this demand annually is from jewelry, 7% is technology, 39% of demand is investment demand. So bars, coins, and ETFs are considered to be investment-led demand, and about 19% of the demand comes from central banks annually. So the Indian demand is a little different, and the drivers for Indian demand are also very different. All of us have been, holding gold, having gold for centuries, right? Some of the Indian families also have gold that has been passed down to them from generations, from your grandmother, great grandmother, and so on. And actually, we've done some analysis on what drives Indian gold demand. Again, here we've seen that in the long term, income becomes a big driver for gold. So, for every 1% increase in demand, the increase in income, the demand for gold goes up by 0.9%. And similarly, gold prices also influence demand both in the long term and in the short term. In the short term, inflation also actually has an effect on the demand. So when inflation goes up, we've seen that gold demand actually goes up by 2.7%. And if you look at prices, like I said, both in the long term and short term, they become a big driver. In the short term, when prices go up, people actually stop purchasing or they buy less than what they would normally do. And we've seen that for every 1% rise in price, in the short term, the demand actually goes down by 1.2%. Likewise, monsoons have a big impact. Every time we have good monsoons, we've seen that demand actually goes up, and taxes have a big factor. So whether it's custom duties, GST, all of that also has an impact on the demand for gold in India. Having said that, like I said, gold is an integral part of our culture. We have various festivals, whether it's Akshay Tritiya, Dhanteras, um, or occasions such as weddings, anniversaries, birthdays. Indians love gold and they buy gold. And the average annual demand has been in the range of 750 to 800 tons. Of course, most of it is in the form of jewelry. Some of it is also bars and coins. And our own central bank, Reserve Bank of India, has also been buying gold. So these are the major areas where actually Indian demand comes from. Now, what do I mean by the strategic case for gold? We've been listening since the second half of this day through various fund managers and fund houses talk about mutual fund products. And here, yet I am talking about gold. What do I mean as for when I say gold as a strategic asset class? So what happens is most people think that gold is just another commodity. It's like a tactical hedge at the most. It's not really different from other commodities including copper, aluminum, etc. And whether there are other better options to protect against inflation is something that people don't understand, how gold actually can fall in these categories. So what is actually gold's role in a portfolio and why do we say it's a strategic asset? Let's take a look. So in terms of returns, diversification and liquidity, something that all of us would like to see, we've done some analysis. We have a lot of historical data as well, and we've tried to see whether gold really produces any returns. Does it give you any returns? Is it really a liquid asset? And can it give you diversification? So we did some analysis on Indian assets, whether it's equities, bonds, corporate bonds, government bonds, and stocks. And we saw over a period of 1 year to 15 years, what is the return that gold gives on a compounded basis. And if you look at the returns from this chart alone, we've seen that gold gives on an average about 10 to 12% annual returns. And if you look at periods of high inflation, again, we've seen that gold does perform well in periods of high inflation. If you look at diversification, today everybody is investing in the equity markets. Most of it is mainly because they are fear of missing out, or FOMO as it is called. Nobody wants to miss out on the rally, so people are buying gold. People are buying equities. Now, in terms of the correlation between gold and equities, we've seen that when equities go up, gold also does well. So if the Nifty or the Sensex does well, we've seen typically gold does well. But when the stock markets crash, gold actually does better. Why? Because it's a safe haven asset. People want to remove money from equities and park it somewhere, and that asset becomes gold. So gold is actually negatively correlated to equities in a falling market. Likewise, if you look at diversification, In terms of geopolitical events, I mentioned earlier, we have had the Russia-Ukraine war, Israel-Hamas war. In all these periods, gold actually does well. Likewise, we've gone back in history, in the 1990s, the Gulf War, the 9/11 bombings in the US, Brexit. In all these periods, gold actually has performed well. Similarly, in periods of systemic risk, we've gone back to the 1990s again when you had the LTCM crisis or the dot-com bubble, the 2002 recession, the sovereign debt crisis, and right up to COVID and the pullback after COVID. Gold has done well in all these periods as well. So it does provide diversification. Even periods after a systemic sell-off, we've looked at the same events again, and we've seen that gold has performed well. If you look at liquidity, gold actually is a very liquid asset class. So if you compare it with Indian equities, Indian bonds, or US Treasury bills, gold actually trades a lot more. Over 120 billion rupees of gold gets traded on a daily basis. And if you look at 2023 alone, gold actually outperformed most asset classes last year. This year, until the month of May, again, gold has done well vis-a-vis other asset classes. And I think, if I'm not wrong, as of today morning, gold again touched an all-time high of $2,706 in US dollar terms. But I think it's important to understand key risks. One is the traditional valuation methodologies that you would use for equities or other asset classes. Gold does not conform to that. Likewise, in terms of cash flows, gold, a perceived drawback is that it does not give regular cash flows. It doesn't give you any dividends, and it therefore doesn't give you regular income. And in terms of price volatility, it's important to understand that gold is a great diversifier because of its behavior, which is so different to equities and bonds. So in terms of understanding the risks, over a medium term, sometimes gold has underperformed. But if you look at annualized returns, we've compared it with Indian equities. Gold has given, on an average, about 12.5% annual returns, vis-a-vis equities, which have given about 13.5%. In terms of volatility, however, gold is much lower at about 15% versus Indian equities that are at about 21%. Now, what does gold do to a portfolio? Everybody wants to have equities. Some people say you should have some debt. Why should you also include gold? Let's take a look. So we did an analysis of a portfolio that had about 55% debt, 45% equities, and we progressively added gold ranging from 5% going up to 15%. And what did we actually see? The risk-adjusted returns in a portfolio with gold and without gold, we saw that the returns actually went up with gold. The volatility came down, and overall reward to risk was much higher with gold versus without gold. In terms of investments, I think you're all great distributors here. I don't need to get into the details, and I've been told I have only 5 minutes left. But if you look at the products that are available, you have gold ETFs, all of which are actually backed by gold. They are secure in the sense that they're also regulated. The market price is transparent because they're on the exchange, and of course they can be used as margins or collateral. For those clients who don't have a demat account, you have gold savings funds or gold fund of funds, and you also have multi-asset funds where you can also do systematic investment plans for your clients. Now, if you look at recent performance and outlook, gold demand has been quite firm this year. RBI alone, our central bank, has bought up to 50 tons of gold in the period ending up to September. So central banks overall have been buying. They've been net buyers and this year the buying has been much higher than what it was last year. If you look at gold ETFs, we've seen a lot of inflows in the last quarter alone, and Western demand in ETFs has also actually been catching up. The first half of the year, we saw Western investors stay away from gold ETFs, but since June, Western ETF demand has gone up. In India, of course, ETF demand has been growing consistently. If you look at assets under management of all the 17 ETFs, it's about over 50 tons, and bar and coin demand has also, it's a little lower, but like I said, last quarter, we have seen Western investors again come in and start buying bars and coins. Jewelry demand, there has been an overall weakness. Technology demand has jumped up, all because of AI and the tech-enabled servers that need gold in all their chips. And mine production is also up 3% year on year. So is this a good time to invest? Interest rates will eventually come down. Weak US dollar is one of the headwinds. Consumer demand for jewelry is definitely going down, but the additional trend to watch is for central banks continuing their buying, Western investment demand coming up, and Asian investment demand again on the rise. So with that, I end my presentation. I'm happy to take any questions. Just one point, we don't give a forecast or outlook on the price, so don't ask me anything about the price. I will not be able to comment on that. Actually, Kerala is one state where gold is very popular, but there's one more product that actually beats gold. And I learned this recently, that's lottery tickets. People in Kerala buy more lottery tickets than they buy gold. So, that's something that's very interesting.
Madam, my question is, the most of the performances you have shown is related to Indian rupee, Indian performance. I am interested to see how the performance in dollar terms.
So bar and coin demand has actually gone up, even from an Indian perspective. People have been buying more bars and coins. If you go to our website, which is gold.org, you will get a breakup of bars, coins, jewelry demand, all of it. But overall, people have increased their bars and coin demand versus jewelry.
Okay, thank you.
Ma'am, you are representing World Gold Council, and how does it benefit? Like, whether, let's say, if I am buying gold as a jewelry or as a bar or as something else, from a local market, how does it benefit you? What is the economics behind, we buying gold from here locally or through an exchange fund with the Gold Council?
See, from our perspective, whether you buy jewelry, you buy bars and coins or ETFs, it's all good. What is important to understand is why are you buying that product? So if there's a wedding in the family, there's an occasion in the family, obviously buy jewelry. But if you're buying for investment or you're buying for your child's education 10 years from now, you would rather invest in a product that's very liquid. Likewise, if you're buying for a wedding, which is, for your child who's only about 2 or 3, there's no point buying jewelry now when the designs could change, and the patterns and the fashion could change 10 years from now. So what we tell people is, understand why you want to buy, understand what it is that you want to buy for. Because if you're buying jewelry for investment, it doesn't work. You will end up actually losing a lot more when you actually try and sell it. And in terms of liquidity also, you might not get the same amount of liquidity.
I think that was not my question. What is the economics? What is the business behind you coming here representing World Gold Council and we people buying gold either as from stock exchange?
So our role is to champion gold as an asset class.
Okay.
We are funded by some of the world's largest gold mining companies. So for us, we want to ensure that the demand is at a sustained pace. That's our mandate.
I think, ma'am, can I make a comment?
Sure.
I think advocacy for gold, am I right?
Yes.
It's basically advocacy for gold as an asset class is what they are doing. Any more questions before I can just quickly summarize ma'am's talk? one more question. Can you just quickly pass the mic? Quick question, sir. We are running out of time. Quick. It has to be very short and crisp.
Madam, in your presentation, you have mentioned that Indian equities have negative correlation with gold. And India is having negative correlation with China. Does it mean with gold is having positive correlation with China?
Sorry, I didn't understand your
No,
question.
in your presentation, you have mentioned that Indian equities have negative correlation with gold. And Indian equities has negative correlation with the Chinese equity. So which means Chinese equity has positive correlation with gold.
Yeah, in terms of demand, Chinese demand is much higher than ours, at about 1,200 tons annually on an average. We are at about 750 to 800 tons. In the past couple of years, we saw in the previous presentation, the Chinese economy is not doing too well. So the jewelry consumption in China has gone down, but the investment consumption of gold has gone up in China. So ETFs have done well. Bars and coins are also doing well. Jewelry per se in China is not being bought as much as it used to.
Okay, thank you.
Yeah.
Okay, thank you. That's a wonderful presentation. Let me quickly summarize what Sheela. 2,12,582 tons of gold in the world. That is what the stock is. Am I right? Yeah. 45% is jewelry, 22% is bars, 17% is with central banks, and 15% other form of gold holdings. What drives gold demands? There is strategic and tactical. Strategic is economic expansion brings gold demand, and risk and uncertainty in the world also stimulates gold demand. And the tactical side is an opportunity, cost, and momentum that drives the demand. And 71% of the gold demand comes from emerging market, 29% from developed market. Average annual net demand is 3,126 tons, which roughly accounts for 195 billion US dollars. So 35% of that is jewelry. And there's a common perception among the investors and investing community is that gold doesn't give much higher return. She was trying to bust that myth. And she also told that people generally perceive gold only as an hedge against inflation. She says that is not right. And she also gave us some interesting thing about correlation between gold and equity. When equity goes up, Nifty, Sensex goes up, gold also goes up. When they fall, the gold relatively performs better. That's what she was telling. And gold definitely there is a genuine case for strategic asset allocation into gold in the form of ETF and many other things she told. Net to net, it was a wonderful presentation, eye-opener, some interesting facts which we were not knowing before. Thanks a lot. Thanks a lot, madam. Big round of applause for her, please.
Thank you. Thanks.
Can I call upon Ramesh to come over and give Sheela a token of appreciation and love from Ignite, AIFA,